Governments and central banks have provided trillions in direct payments and liquidity to support businesses and consumers. Are these stimulus measures propping up the stock markets?
Well, we don't think that these quote unquote stimulus efforts have been propping up the markets, and I'll get to that momentarily. But first, on the term stimulus, and while it might be a bit of semantics, the way we view recent government actions and central bank actions isn't necessarily in the form of stimulus, in the sense that it wasn't designed to stimulate broad economic activity to some higher level that previously existed. But instead, what it was really intended to do was to tide things over, to plug the hole, to fill the gap, to get businesses to the other side of this global pandemic, to get consumers to the other side of this global pandemic. And it wasn't necessarily meant to stimulate final demand, but nor do we think it's really propped up markets, which, an argument that we commonly hear is that, if you think about global stocks today, and Jeff made this point, they're up about 50% off the March bottom. And leads people to believe, well, how could the markets be doing so well if the economic data is coming in and it's so ugly? And it'll continue to be ugly. And if it's not tied to the economy, well, then it's got to be tied to what the government's doing. It's got to be tied to what the central banks are doing. But in our view, that's just blatantly false. I mean, markets are behaving very rationally. Markets are doing what they always do, which is to say they're moving in advance, they're anticipating, and they're pre-pricing today a brighter economic future. I mean, all of this is against a backdrop of pretty skeptical sentiment, which is very consistent with this notion of the pessimism of disbelief. I mean, we've written about this more recently. Ken first introduced this back in 2010. And really what the pessimism of disbelief describes is this notion that in the early onset of a new bull market, people they're quick to dismiss any positives. They latch on to all the negatives, and they just fail to fathom a brighter economic future. And the fact of the matter is what the markets are doing today is they're pre-pricing a brighter economic future 12, 18, 24, 36 months out. And their bull markets are climbing that wall of worry, which is what we're seeing here today.
Yeah, I think Bill is absolutely right. And I would take it even a level further than that. As we go through this recovery, you're going to hear a ton more of this about how the economy can't recover unless. I sort of think of that as kind of 5-year-old thinking, which is that the state of the world is such as it is, and it's very fragile. And if it changes at all, then we're just done. We're broken. And what I think the more enlightened person does, the more mature person does ultimately, and this is a truism in investing, it looks for adaptation. It actually has quite a belief system in what a dynamic place the global economy is. You see that in rapid fashion. When you talk about all the payments that have come towards people just in this country, but all over the world in the last several months, it might be interesting to know that people didn't just spend all that right off the bat. In fact, savings rates have gone up a lot just in the last several months, which to me is a very clear indication that things are more stable than they appear. And the idea that we get fed so constantly, whether it be by governments or sometimes by the media or whatever it is you like to look at, that if you don't get this certain thing, then we're all doomed, or that if you don't have the help from some certain entity, then the world can't go on, to me has always been false. I've always believed that the optimists win in this business. And just as Bill said, is if you look out a year or two and further than that, what you're really going to observe is mass adaptation. One of the things I've seen the most throughout all of this tragic crisis is that the good have gotten better and the things that were a little weaker have actually gotten a little bit weaker. And it's been a very interesting phenomenon. In that way, it's accelerated certain things that are already very dynamic and adaptive in the economy. And I would expect more of that on the way to greater prosperity.
And I think importantly, when you think of the market, market is figuring these things out, who the winners and losers are going to be, and that's very contrary to the narrative that stimulus and central bankers are just propping everything up, because certainly that's not the case. I think sometimes people get overly fixated on just what do the big indexes do, whether it's the MSCI World Index, the S&P 500, and so forth. They see them getting back to all-time highs and say, well, the market's just looking past this entirely, and there's just a lot of stimulus propping things up. That's really not the case at all. It's true that the broad indexes are getting back near all-time highs, but when you start to deconstruct that and look at different sectors and industries and so forth, you'll see that some are doing very well here and have fully recovered, and yet there are a lot of parts of the market that really haven't yet. And that's simply the function of the market, figuring out what types of companies have the business models that can weather this storm and which types of companies have got business models that might really be impaired here. If it were just a lot of stimulus propping everything up, you'd think that everything would have mostly recovered and they're just tracking what the big indexes have done. But when you take it down a layer lower, you can really see the market's actually being quite discerning here. And I think to the point that there are going to be winners and losers, and some parts of the economy and markets are really struggling here. You can actually see that in performance. It might not show up in those headline indexes, but when you start looking at other categories, smaller categories of stocks, you really do see that there are some companies that seem to be thriving now, but there are many times that are indeed struggling.
Many fear that a second wave of infections could derail the market. How do we factor this into our forecast?
Well, of course, analyzing COVID-19, how it's been evolving, what it's likely to do in the future, that's a key area of the research, of our research, and something we're going to be paying very, very close attention to. But I want to take you back to something that we said at the onset of all of this, that what the market is reacting to isn't the virus itself, it's the institutional response to the virus. And by that, I mean the travel bans, the shelter in place, the lockdowns, and so forth. That's really what's impacting the economy. We've seen epidemics, we've seen pandemics before. What we've never seen are the type of institutional responses that we're seeing this time around. And that's really what's weighing on the economy and has led to most of the market volatility this year. And so while we don't know exactly what's going to happen with the virus, will we get another wave or not, you can look at a bit of recent history and say, well, here in the US at least, you have seen a bit of resurgence in some areas, and that hasn't held back the very healthy recovery we've seen so far. And I also think it's important to consider that as we might go through another wave of the virus, again, I don't know if we will or we won't, the response is likely to be very different this time around. Both the institutional response, but also the response by investors as well. It's not likely, I would say, not impossible, but not likely that we go into complete lockdown mode again. There might be renewed lockdowns, there might be some greater efforts to try and contain the virus, but the approach we took, or politicians took initially, as this was coming at them very quickly and in unprecedented ways, rightly or wrongly, was to lock things down entirely to try and prevent the spread. It's very likely that the next time around, you might get a different type of institutional response that maybe won't be quite so severe. And that's what the market's really reacting to. Also, I think investors themselves have had a lot of time to be more comfortable with the state of the world that we're in today. And what you see many times throughout history is when you get an issue like this that is recurring. And think about some of the tensions we've had between the US and China, trade relations and otherwise. When we were really starting to get new information about this, say back in about 2018, every headline that came out about a tariff or some other trade issue caused a lot of market movement. We're still getting a lot of those types of headlines today. They're just not impacting the market nearly as much. Time and time again, you see examples of these kind of long-term issues that persist for a while, losing a lot of their market moving power the longer it goes on. So here we are, by the time we get into flu season again, we'll have had a number of months for planning in terms of what the institutional response to that might be. But also, investors are a bit more weathered today. They've built up some internal defenses that probably means their reaction won't be as great as it was last time around as well. Now, with all of that said, these are things we're going to be watching very closely because things could go the other way. Maybe we do go back into complete lockdown mode. Maybe that does have an impact. So we're going to be watching these things. But my guess is that the response by governments, regulators, and by investors is likely to be different and maybe less severe than we saw in the initial onset of all of this when it was all brand new information.
And for views on current events in the world of investing, visit marketminder.com. Updated daily, it offers on-demand access to Fisher Investments' most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.